Balancing business investment portfolios. Introduction. In this video, we explore how businesses can balance their investment portfolios for long-term success. A balanced portfolio helps manage risk, improve returns, and support the company's financial strategy. Whether it's a Kenyan SME expanding into new regions or a multinational in Europe adjusting for market shifts, portfolio balance is essential. Key focus areas include understanding investment portfolio structure, strategies for diversification, asset allocation principles, importance of regular reviews and rebalancing. What is an investment portfolio? An investment portfolio is a collection of financial assets that a business owns with the aim of generating returns. These assets may include stocks, bonds, real estate, unit trusts, or private equity stakes. Purpose of an investment portfolio: grow company wealth over time, manage financial risk, align investments with business strategy. For example, a Kenyan logistics firm might invest in government bonds for safety, while an American retail giant may prefer stock repurchases. Why balancing matters? A well-balanced portfolio protects against extreme losses while still allowing room for growth. It ensures that investments match the company's goals, risk appetite, and cash flow needs. Key benefits: smoother financial performance during market changes, more control over short and long-term objectives, better liquidity for strategic decisions. A Kenyan bank may keep a large portion of its portfolio in government securities to meet liquidity regulations. Principles of balancing portfolios. Diversification. Spread investments across different asset classes and industries to reduce risk. Risk tolerance. Understand how much financial risk the business can take without jeopardizing operations. Asset allocation. Divide capital between asset types, like equities, bonds, and real estate, based on risk and return goals. Understanding risk and return. Risk refers to the potential for financial loss. Can result from market volatility, poor business performance, or external events. Return: the profit or gain generated from an investment. Generally, higher returns come with higher risk. For instance, a Nairobi-based tech firm investing in cryptocurrency may see high returns, but also extreme fluctuations. Diversification strategy. How diversification works: reduces exposure to a single asset or industry, ensures one poor performer doesn't drag down the entire portfolio. Example mix: tech stocks, high return, high risk; government bonds, low return, low risk; commercial property, moderate risk and return. A Nairobi-based real estate company might also invest in U.S. mutual funds to hedge local risks. Assessing risk tolerance. What affects risk tolerance? Business size and financial health, market stability and business life cycle, leadership vision and sector volatility. Risk profile categories: low risk, mostly bonds or fixed income; moderate risk, balanced between stocks and bonds; high risk, focused on equities or startups. A mature firm in Mombasa may adopt a low-risk strategy, while a new fintech in Lagos might go high-risk for faster growth. Asset allocation explained. What is asset allocation? Distributing investments across asset types to match strategy. Common asset types: equities, public and private shares; bonds, treasury bills, corporate debt; real estate, commercial, residential, or REITs. Strategic allocation ensures better control over performance, resilience during market shifts, alignment with both short-term and long-term goals, creating a balanced portfolio. Step-by-step guide. Assess financial objectives, e.g., expansion, reserves, or dividend yield. Select suitable asset classes based on your business risk profile. Determine proportion of funds and allocate accordingly. Example portfolios. Low risk, 40% bonds, 40% real estate, 20% stocks. Moderate risk, 30% bonds, 50% stocks, 20% real estate. High risk, 10% bonds, 80% stocks, 10% real estate. A Nairobi cooperative society might lean toward a low-risk portfolio with treasury bonds and SACCO fixed deposits. What is rebalancing? Definition. Rebalancing is the process of adjusting asset allocations to maintain the original risk/return profile. When to rebalance? After market shifts. Annually or semi-annually. After achieving a financial milestone. How it's done. Sell overperforming assets. Buy underweight assets. Restore balance based on current business strategy. Monitoring portfolio performance. Key performance metrics. ROI, return on investment, measures actual returns. Sharpe ratio, compares return to risk taken. Standard deviation, measures volatility. Why monitor regularly? Spot underperforming assets. Adjust strategy based on performance. Stay aligned with changing business needs. A Kenyan agribusiness firm may monitor returns quarterly to plan for future seasonal investments. Aligning strategy with business goals. Align investments with cash flow needs, growth targets, operational expansion or entry into new markets. Short-term goals require safe, liquid assets like money market funds or T-bills. Long-term goals need growth-focused investments such as equities or property. A company planning to expand into East Africa within 5 years might allocate more to regional stocks and infrastructure funds. Tax considerations in portfolio balancing. Why tax matters. Taxes can erode gains. Efficient planning improves net returns. Strategies to reduce tax impact. Use tax-deferred accounts where available. Invest in tax-exempt bonds like municipal or infrastructure bonds. Schedule asset sales during favorable tax periods. Kenyan businesses often prefer infrastructure bonds, which are tax-free and offer predictable returns. Common mistakes to avoid. Don't over-concentrate investments in one asset or industry. Ignore your business's true risk tolerance. Forget to rebalance regularly. Make emotional decisions during market fluctuations. Do stay objective and disciplined. Follow a structured strategy. Revisit the portfolio regularly. Case study, balanced portfolio in action. Scenario. A Nairobi-based construction company decides to invest 100 million Kenyan shillings for long-term growth. Strategy. 50% in NSE blue-chip stocks. 30% in government bonds. 20% in commercial property. Result. Strong growth. Steady income. Minimal impact during inflation or currency shocks. Periodic portfolio review. Why review regularly? Business goals evolve. Market conditions change. New risks and opportunities arise. How often to review? Annually or semi-annually? After major financial events. What to review? Asset allocation. Performance against benchmarks. Risk exposure. A Nairobi fintech startup may do quarterly reviews to ensure growth targets align with capital investments. Balancing a business investment portfolio is not a one-time task, it's an ongoing process. Businesses that apply diversification, smart asset allocation, and regular rebalancing are more resilient to shocks and better positioned for sustainable growth. Alignment with business goals ensures every shilling or dollar works toward your long-term vision.